If we go straight into the portfolio, one of the biggest shares in the portfolio at the moment is Sasol, and it's been one of the biggest detractors from our performance over the last year. So let's take a closer look at Sasol. The grey bars in this chart show Sasol's reported earnings per share since 2008, and the blue line shows the Rand oil price. So you can see that a rise in oil price was very positive for Sasol, and Sasol's earnings per share grew strongly. Clearly, the oil price is a very important determinant of Sasol's profitability. But from 2014 onwards, the oil price started falling, and not unexpectedly, Sasol's earnings per share fell, and we expect them to continue falling. So if you now look at the red bars show our forecast for Sasol's earnings per share. You can see we expect lower earnings per share in 2016. But very importantly, from that point onwards, we expect Sasol's profits to start growing again. And more importantly, that's not because we expect oil prices to go back to $100 a barrel. Okay? If you look at the assumptions that we've put into our forecasts, we've got oil prices growing just to $70 a barrel by 2020. And nor have we put in or factored in a significant depreciation in the Rand. We've got the Rand depreciating with the inflation differential from here. What is driving this recovery in Sasol's profitability? Well, it's firstly a cost savings program which David Constable put in place 2 years ago, to his credit, and which we expect to deliver significant benefits. And then secondly, the capital projects which Sasol has been building and which will start to yield results. The most important of those is the chemical plant in Lake Charles in Louisiana, which we expect to start contributing from 2019 and 2020. And you can see that in the shaded section of the bars here. So if we look at Sasol's valuation, Sasol's on a 9 times price earnings multiple at the moment. Now you might well say, well, hold on, we know that profits are going to fall in the coming year. And so what we could do is look at the forward PE multiple. So that's the multiple of the price to the profits we expect in the coming year. And in that case, you're paying 12.5 times forward earnings for Sasol. Now, if we compare that to, let's say, MTN, which is on a slightly higher forward multiple, you can see that we're expecting much higher growth in Sasol's profits from 2016 onwards, around about 20% per annum, compared to MTN less than 5%. If you compare Sasol to two quite popular companies at the moment where growth expectations are quite high, Steinhoff and Mr. Price, both of those companies are on over 20 times forward PE multiples. And yes, we do expect them to grow, but there's a good chance that Sasol may grow its earnings per share faster than those two companies which are on much higher multiples. So is Sasol a value stock because it's on a low PE? Is it a growth stock because we expect earnings to grow strongly from 2016 onwards? I don't really call what you want to label it. The real question is whether it's a good investment, and I think it will prove to be so.